introduce today as a guest speaker Dr. A.L.Kostin, who is the President and Chairman of the Management Board of VTB Bank, and Andrei Leonidovich is the member of the Advisory Board for Graduate School of Management, St. Petersburg University. Today we welcome Andrei Leonidovich not only as the member of the Advisory Board, but also as a candidate to the position of the Dean of Graduate School of Management. Let me give the word for a few introductory remarks to the acting rector of St. Petersburg University, Professor Garlinsky.
Thank you very much. Good morning, dear Andrei Leonidovich, dear ladies and gentlemen. Our rector, Professor Kropotchev, would like to attend this meeting, but unfortunately he is currently in Moscow, participating in a significant session of the State Commission regarding reorganization of effectiveness universities. In this regard, he asked me, as acting rector, to open today's appointment and express our gratitude to Andrei Leonidovich, who agreed to lecture for students studying management at our university. As President, Chairman of the Board of VTB Bank and member of our Board of Overseers of Graduate School of Management, he has outstanding management skills and tightly connected to our university. I'm sure that this meeting will be extremely interesting and useful for future leaders of Russian and international business. Andrei Leonidovich, let me open our meeting and give you the floor.
Good morning. It's a great pleasure for me to deliver a lecture in the Graduate School of Management. The topic of our lecture today is Global Financial Crisis, 5 years on, Banker's View. Obviously, it would be naive to think one could squeeze the whole range of complicated issues in one academic hour. However, I'll try to give the practitioner's view on the issue within the allocated time. I will have my presentation with slides for about 1 hour and to leave about half an hour for Q&A session. Next slide shows a little bit the company I represent. It also shows the growth of the Russian banking sector over the last 10 years since I've been appointed as a chairman and CEO of VTB. As you see, the assets of VTB group grew 36 times in these 10 years, from 6 billion to more than 200 billion. It just shows that the growth in the Russian financial sector and Russian industry was quite substantial. But going back to the main subject of the lecture, slide 3, I would like to deal a little bit with the crisis itself and what caused this crisis. Since the outbreak of the credit and then global financial crisis, the debate over its main causes is still going on. The suggestions range from increased trade imbalances and loose monetary policy to such exotic ones as excessive risk-taking and even the role of testosterone in male-dominated trading floors, which I think is quite important. If we put aside the risks explained by behavioral finance, I would outline at least 3 principal causes of the 2008 crisis. That is, deregulation, openness, and globalization. Let's call them DOG for short. So as we say in Russian, when we want to clarify causes of phenomenon, let's find out where the dog is buried. Hence the first cause of the crisis, deregulation of the financial sector in pre-crisis period, which caused the increase in leverage and bank assets. The Financial Crisis Inquiry Commission, set up by the US Congress to investigate the causes of the crisis concluded that more than 30 years of deregulation and reliance on self-regulation by financial institutions had stripped away system's key safeguards. Just a few examples to illustrate. In 1977, when the US economy was subject to an unprecedented wave of credit squeeze, American Congress, enacted the Community Reinvestment Act that encouraged more lending, even to borrowers to whom banks may have previously denied credit. As a result, household credit expanded from 48% of GDP in 1980 to 99% of GDP in 2007. The securitization technique that emerged in the 70s made it possible for banks to remove the subprime mortgage assets from balance sheets and go on lending. In 1991, Congress lifted so-called Glass-Steagall restrictions, which had been in force since the time of Great Depression in 1933. As a result, traditional banks were allowed to compete directly with investment banks in securitizations, stock and bond underwriting, and trading what's called in over-the-counter or OTC derivatives. That was the beginning of the golden age of the universal banking model, which is characterized by a large-scale introduction of structured products. For 7 consequent years, up to 2007, the annual growth of banks' assets was 16 to 20%. As banks grew, they increased leverage. As of 2007, the leverage ratio of 5 leading investment banks in the United States was 40 to 1. For every $40 in assets, there was only $1 in capital to cover losses. High leverage meant higher returns, but less capital to absorb losses. The second cause of the crisis, opaqueness. Growth of opaque derivatives market as a result of deregulation and the spread of risk due to them. There are no risk-free financial markets. Finance is inherently risky. In financial markets, risks do not evaporate. They are transferred. One of the ways to transfer payment default credit risks is to use derivative contracts. Universal banking, coupled with innovation from financial engineering, such as securitization, generated myriads of derivative instruments in deregulated financial markets. Former IFRS chairman Alan Greenspan advocated the regulation of the derivative market. In 2000, President Clinton signed an act to exempt over-the-counter derivatives from virtually all regulation or oversight. As a result, the market boomed. At the end of 2000, outstanding OTC derivatives globally were $95 trillion. In June 2008, the volume increased to $672 trillion. By comparison, the global GDP stood at around $60 trillion. A key OTC derivative is credit default swap, or so-called CDS. The value of CDS grew from $631 billion in 2001 to $62 trillion in 2007, an increase in almost 10,000%. And the use of CDS did not wipe out the credit risk, but spread it across the system. The risk became less visible and more opaque. Not surprisingly, that during the crisis, Warren Buffett, the famous investor, became nearly the most cited living person. As early as in 2002, he described derivatives as financial weapons of mass destruction. Opaqueness manifested itself in another phenomenon, which became a source of systemic risk. I mean, shadow banking. This phenomenon deserves being discussed more precisely. The shadow banking sector is a very topical issue and a matter of concern for regulators. According to the Financial Stability Board, the assets of 11 largest national shadow banking systems, which include United States, United Kingdom, and other leading countries, grew from $23 trillion in 2002 to to 51 trillion in 2010 and 67 in 2012. So less than in 10 years, the sector has tripled. What is shadow banking? Well, it has nothing to do with any illegal or criminal banking. This system is broadly described as a credit intermediation involving entities outside the regulated banking system. The entities vary and include structured investment vehicles, for example, hedge funds, money market mutual funds, investment funds, and so on and so on. How do they work? This can be illustrated for the example of money market funds. These funds sell their shares to institutional investors, like pension funds. The money the fund gets, they invest in short-term debt instruments issued by companies. Let me remind you of the Reserve Primary Fund case. The notoriously famous fund worked with Lehman Brothers, buying its commercial papers. Naturally, the collapse of Lehman led to the difficulties for primary reserve. Facing non-payment risks, the investors ran on these and other funds to redeem their shares. They withdrew a total of $480 billion in cash. Since the mutual funds were not regulated by the Fed, they did not have access to the regulator's funding or safety nets. To cover the claims of shareholders, the funds had to sell their assets. And due to a huge volume of the assets, these fire sales fueled panic in financial markets. Today, shadow banking system constitutes some 30% of the total financial system and is around half the size of bank assets. Despite growing talks and efforts by regulators to rein the shadow banking in, the system has become even bigger than before the crisis. According to the European Central Bank, shadow banking remains one of the main sources of financial stability concerns. On the right graphic, we see range and dynamic of deposit instruments provided by shadow entities to regulated banks. On the left graphic, we see breakdown of deposits originated from various financial intermediaries. The most conservative and transparent of them, pension funds, make up only 10%. Euro area banks rely increasingly more on funding from the financial sector. This type of funding has grown from 20% in 2004 to over 30% as of today. The links between the bank-regulated institutions and non-bank financial intermediaries have strengthened. This increases the risk of contagious through transmission of shock across institutions. The concern of the regulators is that in stress scenario, liquidity dries up quickly in certain markets, leading to sudden stops in fundings. Shadow banking is associated with contagious risks. So opaqueness was typical for two growing markets, derivatives and shadow banking. The third cause of crisis is globalization. Globalization is in the financial service industry, which was accompanied by lax global regulation. Rapid growth of the derivatives markets was fueled by international regulation. In 1996, the Basel Committee on Banking Supervision adopted an amendment to Basel I. This provided that if banks hedged their risk using derivatives, they could hold less capital against their exposures from trading and other activities. In 2002, the Basel regulations provided that mortgage-backed securities, so-called MBS, required a bank to hold only 1.6% risk-based capital, while whole mortgages required 4%. This made MBS much less expensive to hold than whole mortgages. And mortgage-backed securities are the basis of credit default swaps. So increase in MBS led to increase in CDS derivatives. In 2004, the Basel II allowed banks to lower their capital charges if they could show they had sophisticated internal models for estimating the riskiness of their assets. The largest banks that could set up expensive modeling system gained from the regulation. Finally, the Basel II reform failed to hold credit rating agencies to account. By erroneously rating the bundles of mortgage-backed securities, the agencies contributed to the creation of toxic financial assets. Thus, globalization combined with lack of prudent global regulation became the factors that at the end of the day aggravated the magnitude of the crisis when it started. Now, next to crisis, time frame and immediate results. What is the time frame of the credit crisis? According to the Bank of International Settlement, the credit crisis ran from June 2007 to early 2009 and had 5 stages. If we take a look on the chart, we can see the crisis got an international dimension on its second stage in fall 2008, when Lehman Brothers got bankrupted. The crisis has had a massive adverse impact on global banking system. Total estimated bank write-downs and loan provisions reached $1.5 trillion. From September 2008 to June 2009, the overall amount of resources committed to the various bailout packages of 11 advanced economies totaled around 90% of their GDP. The crisis came from the United States. That is why so much attention is given to this economy. In the United States, during the last 30 years, there was an enormous growth in financial services sector. As its peak in 2006, this sector contributed 8.2% to US GDP compared to 4.9% in 1980. It is securities and credit intermediation that are responsible for the acceleration of the growth. The growth of financial sector to GDP can be seen across other jurisdictions. In the UK, financial and insurance activities grew to a peak of 10% in 2009. So we have covered our dog or key causes of the crisis. Let's get a short overview. Financial regulation made it possible to use new structured products or structured derivatives and financial vehicles, securitizing structures and other shadow banks. This led to formation of opaque derivative market, excessive money supply, and the boom in financial services, which naturally spread credit risks. The overheated economy fueled with credit supply sparked overproduction crisis. Globalization, combined with lack of prudent global regulation, became the factors that in the end of the day aggravated the magnitude of the crisis when credit risks crystallized. This ended with the credit crunch and economic crisis. The era of great moderation, characterized by reduced volatility in business cycles and financial markets, was over. How is this time different? In 2009, Harvard professor Carmen Reinhardt and Ken Rogoff published a book. This time is different. The study presented the results of 224 banking crises across the globe for the last 8 centuries. The book shows that the crises have always been around. So in what way is this time different? Mass media compare the crisis with the Great Depression, trying to find similarities. Some even called it the Great Recession. However, this time is different, at least in terms of decrease of GDP. From 1930 to 1933, the US GDP collapsed by 27%, unemployment rose from 3% to 25%, 8 times. This time, the economy fell 4%, and unemployment rose from 4.8% in 2007 to 10% in 2009, which is, in comparison with the previous, of course, with the Great Depression, it means that only twice as much as it was before the crisis. Few facts on this issue. According to the National Bureau of Economic Research, the US recession started in December 2007 and ended in June 2009. US real GDP growth has averaged 2.2% since then. Despite a 7.9% fall in 2009, Russia's GDP returned to its pre-crisis level in 2011. In 2011, the country ranked 9th globally in terms of its GDP, moving 2 positions up from the 11th place it took in 2007. Global GDP contracted by 2.2% in 2009 as a result of the crisis. However, in 2010, the global economy rebounded, growing by 4.2%. But the exit from the recession caused by the financial crisis of 2008 doesn't imply a return to uninterrupted growth. Concerns over the headwinds of global economy are still there. This time is also different in terms of spillover effects. The Systemic Banking Crisis database issued by the IMF covers the period from 1970 to 2011. The study identifies 147 banking crises, 218 currency crises, and 66 sovereign crises. The research shows that banking crises frequently turn into twin crises, banking plus currency or sovereign debt crisis. Those involving both banks and sovereign debt are least common. There were just 11, and the current sovereign crisis in Europe, in Euro area member states, are among them. The crisis of 2008 in the US could be characterized as a systemic banking crisis. The IMF study also shows that the impact of crisis of advanced and emerging economies differs. Monetary expansion and increases in public debt resulting from a banking crisis are larger in advanced economies. For example, the Euro area government's gross debt to GDP ratio is estimated to have risen from 66% in 2007 to 90% in October 2012. In the emerging markets, monetary policy tends to be more stringent. Emerging and developing countries face capital outflows and large currency depreciations upon which they respond by tightening monetary policy. For example, Russia's central bank kept the interest rate high while the US and the EU decreased the monetary tool. And now it is high time we covered regulatory and monetary response. Judging by the frequency of crisis, one may draw a straightforward conclusion that no amount of regulation will end financial crisis once and for all, and she will be right. Financial regulation is often reactive or ex-post. It deals with risks that have crystallized, and it is no way a 100% guarantee against future losses. On the other hand, prudent regulation is likely to mitigate the frequency and severity of financial crisis. The ultimate goal of global regulatory reform pursued across the G20 countries is to make financial and banking system a valuable asset of the economy rather than a threat to its development. To this end, the global regulatory reform proceeds along following paths. The first path is strengthening prudential regulation to improve banks' capital and liquidity buffers to reduce systemic risk. The result was Basel III. The agreement aims to increase both the quality and quantity of banks' capital and ensure that banks can withstand a prolonged disruption of funding markets. The second path is enhancing supervision, including the need to integrate micro and macroprudential oversight of the financial sector. The result was the creation of the Financial Stability Board at the G20 and new regulatory structures on national level, like the European Systemic Risk Board in the EU. Discussions are held to establish a mega regulator in Russia. I should note here that changes in structure are unlikely to lead to a better system of supervision. The failure was not in who, but in how. The third path is addressing the risks of too big to fail, associated with the default of systematically important financial institutions. A number of initiatives have already been taken or are being currently considered. One of the approaches is to require the big institutions to hold capital and liquidity buffers well beyond the Basel III. This is advocated by the Financial Stability Board and Basel Committee on Banking Supervision. The two bodies annually update and issue the list of global systematically important institutions. The additional loss absorbency requirements for those institutions are to be fully met by 2019. Nobel economist Joseph Stiglitz expressed a concern with too big to fail banks, stating plainly, if they are too big to fail, they are too big to be. So the second approach is to limit the range of business activities that big banks are allowed to carry out. This approach can be found in the Volcker Rule in the US and ring-fencing proposals of the UK Independent Commission on Banking. I will expand on it a little bit later. The fourth path of global regulatory practice is expanding the bank regulation process so as to reduce moral hazard and mitigate the economic costs of financial crisis. There's no agreed resolution regime for financial institutions yet. Mervyn King, the governor of the Bank of England, has pointedly observed the financial institutions are global in life but national in death. The obligation to bail them out falls back on their home authorities. The UK and the US have introduced contingent resolution plans for systematically important financial institutions. These institutions would be required to devise detailed and regularly updated plans for dissolution that need to be approved by the supervisory authorities. There's a concern that a banking group may have to adjust its own living will frequently as its business evolves, and supervisors may find it difficult to regularly assess such adjustments. The fifth path is fortifying financial market infrastructure. To dampen spillover effects and systematic risks, the G20 agreed that all standardized derivatives contracts should be cleared through central counterparties by the end of 2012 at the latest. The work on this is still in progress. Let me make some conclusions here. Noteworthy, the reform of financial regulation has focused mainly on already highly regulated financial institutions, banks. According to the Institute of International Finance, which represents 400 financial institutions across the world, tighter capital and liquidity requirements will make banking business more costly, and this will have an adverse impact on global economy. The Institute estimates the Basel III implementation could slice over 3% of GDP in Europe, North America, Japan, and the UK by 2015, and leave the global economy with 7.5 million fewer jobs. With higher capital requirements for banks, the risk is that lending activity may be pushed forward, less regulated financial intermediaries and markets, or so-called shadow banking system we have considered earlier. One of the key lessons of the crisis is that financial regulation based on overseeing banking, securities, and insurance sectors proved to have flaws. The regulatory perimeter should be expanded. Well, in a nutshell, if you now look at the situation all around the world, there is a big debate between the bankers and regulators. The bankers claiming that much more severe regulations might lead to more expensive banking and as a result, less loans given to the economy, while regulators, of course, being very much concerned after the crisis, is trying, I would say, to squeeze or to limit the expansion of the banking, in particular reducing the risks and imposing more and more regulatory requirements which provide as an additional cost to banking. I think the compromise will always be found somewhere in between these two extreme positions. The need for sound global governance and cooperation is becoming even more apparent. On this front, one change has already occurred. The G20 has replaced the G7 as prime forum for international economic cooperation. The creation of the B20, which gathered CEOs from 20 economies, made a practical link between business and politicians. There's a constant interaction between government decision makers and business practitioners. The G20 also created Financial Stability Board, which provides a constant monitor over regulation practices across the key economies and markets. As you all know, Russia is hosting the G20 summit here in St. Petersburg in September 2013. The final agenda is currently under consideration. Russia's presidency will focus on the managing sovereign debt and attracting long-term investment problem. A spotlight will also be on shadow banking. In November, the G20 finance ministers said that they expect finalized policy measures for oversight and regulation for shadow banking to be reviewed by the summit in St. Petersburg. The G20 is an important mechanism to spot both current issues and disagreements over them. Not all of the initiatives proposed by the presidency are endorsed. Some of them fail, but implemented on the national level later. A good example is financial transaction tax. After the G20 didn't support additional taxation on financial transactions during the summit in 2011, in October 2012, the European Commission backed plans for 10 countries to launch the tax. The idea is to impose a small charge on transactions of currencies, bonds, and shares traded at banks and financial institutions to help raise funds to tackle the debt crisis. One of the risks stemming from the adoption of the tax in 10 jurisdictions relates to regulatory arbitrage. The tax could drive business to financial centers that didn't impose it. By the way, Russia was among the nations that didn't support the taxation. Now let me talk a little bit about different crisis responses across the economies in different regions and different countries. We'll start with the largest world economy, which is the United States. According to the Federal Reserve System, the crisis was different in the institutional structure. Hence, it was not banks and depositories. It was investment banks and shadow banking. To constrain risks within the investment banking and the whole financial system, the Congress adopted so-called Dodd-Frank Act in 2010. The act prohibits proprietary trading with hedge funds and private equity funds, so-called Volcker Rule. It also foresees an orderly liquidation mechanism for banks. The legislation provides for the regulations of over-the-counter derivatives. However, after 2 years, the implementation of Dodd-Frank has been partial. Major items have been delayed and debate continues over its effectiveness. Government agencies that have been tasked with writing the detailed rules have faced pressure from critics and proponents alike. The Commodities Future Trading Commission and the Securities and Exchange Commission continue to delay meeting OTC derivatives rulemaking deadlines. Regulators still have to approve many rules based on the Act, including regulations for the Volcker Rule. The current chairman of the Federal Reserve, Ben Bernanke, is said to be holding the position in the right time for him. Ben Bernanke, who is often referred to as an expert in the Great Depressions, said the Fed has been pursuing the current policy in line with its two lessons. First, in the financial panic, the central bank has to lend freely. Second, monetary policy should be accommodative to help avoid a deep depression. The Fed has cut the short-term overnight interest rate called the federal funds rate to 0.25%, so just 0.25%. This instrument cannot be cut any further. The main tool that the Fed is using now is the large-scale asset purchases, more known as QE. QE1, introduced in March 2009, QE2, introduced in November 2010, and QE3, September 2012. These sections boost the Fed's balance sheet by more than $2 trillion. The ultimate goal is to stimulate the economy by lowering yield across a range of securities, treasuries, corporate bonds. The previous QE program had a positive effect on the US financial markets. Standard & Poor's index gained 50% in 2009, 30% in 2011. It is too early to get the results of the asset purchases program adopted in September 2012. Unlike previous programs, the Fed's third round of quantitative easing, QE3, does not have a defined limit and will continue until the labor market improves. Today, unemployment in the US stands high at 7.9%. As a result of the QE2 program, the market has been boosted by 700,000 jobs. United Kingdom. The regulatory agenda in the UK is similar to that of the US. According to the Banking Act in 2009, the Bank of England was given dual mandate, financial and price stability. In the US, the Federal Reserve does also have a dual mandate, employment and price stability. The UK government has substantially expanded the supervisory powers of the Bank of England. The bank will regulate all deposit-taking institutions, insurers, and investment banks. In March 2009, the Bank of England reduced the rate to 0.5%, so 0.5%, which is the lowest level in the bank's 300-year history. The bank said that the rate could not practically be reduced below that level. To give a further monetary stimulus to the economy, it decided to undertake a series of asset purchases. Since March 2009, total asset purchases equaled 375 billion sterling. The key aspects of the banking reform in the UK were proposed by the Independent Commission on Banking. The focus is on the ring-fencing, separation of traditional investment banking. The reform is expected to be completed by 2019. The European Union. While union regulatory framework in the US and the UK has been developed in response to the financial crisis, the EU reform agenda is more sensitive to current economic conditions. Today, the distinct driver for financial reform in the EU is the sovereign debt crisis in the euro area. The twin crisis, as we mentioned earlier, of course, the most famous case is the sovereign debt of Greece. The task of the EU authorities is to break the link between the creditworthiness of banks and that of their sovereigns. A recapitalization of a troubled bank by its government may lead to a deterioration of the government's fiscal position. And the deterioration fiscal position, in turn, further weakens banks' balance sheets through their holdings of sovereign bonds. To break this vicious circle, the EU Council decided to establish a banking union comprised of three pillars: single supervisory mechanism, deposit guarantee schemes, and resolution fund. The creation of single supervisory mechanism by 2014 will make it possible for banks to be directly recapitalized by the European Stability Mechanism, not by the individual states. Until now, the ECB has undertaken crucial steps to support the banking system by providing the financial institutions with much-needed liquidity through long-term refinancing operations. The cost of finance for the 3 years facility was set at just 1%. The European banks have taken up a total of 1 trillion euros under the scheme. Policymakers in Europe seem to be obsessed with austerity measures. The debate on fiscal consolidation versus growth is very topical today. Fight debt with more debt is no longer a solution. Growth can be achieved by spending programs which fuel the economy for a quarter or two, but are not sustainable in the long run. Austerity measures create confidence that investors need. On the flip side, budget cuts and tax hikes create social discontent and increase in unemployment. Last month, unemployment in Greece and Spain hit a record high. One thing is for sure: though there are negative effects in the second term, sound fiscal policies are essential to lower borrowing costs and encourage investment in the long term. To summarize this part of our lecture, I would like to say a few words. While analyzing the responses to the crisis across the economy, an important trend can be identified, namely reinforcement of the central bank's role. In crisis conditions, central banks maintain financial and economic stability through the provisions of liquidity and interest rate adjustment policy. However, as critics say, the reshuffling of supervisory responsibilities per se does not take away the fundamental problem, still relying upon national regulations to confront the challenges of financial globalization. Banks have been blamed for the crisis. However, the regulators see banks as a key tool to restore growth. If we compare the situation in America and Europe, and the regional stage of the crisis, the politicians, starting from Mr. Obama to Mr. Sarkozy, was extremely critical. And I would say had a role which raised a certain anti-banking emotions. But now the European bankers complain that though the rhetoric of Mr. Obama was quite strong, in practice, the American authorities are much softer in their approach to increase regulations against the banks, while the Europeans, who effectively, of course, now in the middle of the global crisis, are now taking the most strongest measures, and thus making the European banking industry not very much competitive. Now, I'd like to say a few words about us, about Russia, about crisis in the Russian banking sector. The crisis of 2008 didn't originate in Russia. However, due to its strong engagement in the world economy, the country was hit hard. The negative impact came from two channels, trade and finance. In 2008, Russia's export totaled 30% of GDP. External corporate debt equaled 25% of GDP. In 2008, the share of foreign banks in Russia's interbank lending market amounted to 73%. Foreign banks made around 11% of total Russian banks' liabilities. Obviously, sharp decline in commodities prices and the freeze on international lending market hit Russia's budget and paralyzed its banking system. The capital outflow of $130 billion by the end of 2008 made the situation even worse. In 2009, the economy contracted by 9%, and the state ran a budget deficit of 6.3% GDP. Companies found it hard to extinguish or refinance their debt. Bank non-performing loans increased from 3.8% in 2008 to 9.5% or nearly 10% in 2009. The government wasn't decisive enough in its actions. The state spent around $400 billion to bail out companies and support the financial currency. This prevented banking crisis, hyperinflation, or widespread unemployment. Let's talk about banking sector in Russia. Though the crisis has also affected Russia's banks, the central bank policy was different from that of European Central Bank or Federal Reserve. The Bank of Russia provided assets to commercial banks, but at extremely high rates. In contrast to developed economies, which reduced the rate, as I mentioned, to 0.25% or 0.5%, Russia's refinancing rate stood in 2008 at 13%. In 2009, it decreased to 8.75, and now it stands, as you probably know, at 8.25. Why the central bank is doing it? The central bank is very much focused on inflation and use it at a high interest rate as a main instrument to prevent more loans coming to the economy, thus overheating the economy, providing larger money supply, and thus reducing the basis for the growth of inflation. I mean, the issue is very much debatable because, on the other hand, such policy restrain the economic growth and not allow the companies to borrow more money, and it means that at the end of the day, we are losing the economic growth. But as a counter-inflation measure, that proved to be quite efficient. What did the RCB do tackling the crisis? The central bank allocated enough funds to inject liquidity in the banking sector. In the fourth quarter in 2008, the Bank of Russia extended credits to local banks. During 2008, the share of the central bank assets in the banking system liabilities increased from 0.2% to 12%. So how much? 60 times. To tackle the crisis impact, the Bank of Russia reduced the required reserve ratio for credit institutions, which let the banks allocate over $10 billion from the regulator. The central bank significantly expanded the so-called Lombard list of securities allowed to serve as collateral for credits. It also extended the credit period from 3 months to 6 months and later up to 1 year. But in comparison, in Europe, the European Central Bank is lending money up to 3 years now. Since price of shares used as collateral for interbank lending was sinking, the repo market was almost paralyzed. Banks were allowed not to reinvest, not to re-estimate securities in their portfolio in accordance with their current market value. Finally, to increase confidence in banks, the deposit insurance for people, for retail customers, was extended from 400,000 rubles to 700,000 rubles, which has made individuals confident in banks. So during actually the crisis in Russia, we didn't see a large withdrawal of cash by individuals, of course, in comparison with the Russian crisis in '98, when it led to the collapse of many private banks. Now, I have to admit that these actions taken by the Russian government and the Russian Central Bank were quite effective. In 2011, Russian banks got a record profit of almost 850 billion rubles, which is 1.5 fold than that in 2010, or fourfold than that of 2009. The volume of deposits reached a record high of almost 12 trillion rubles in 2011. Bank assets increased by 23% and totaled 41.6 trillion rubles. The bank's asset to GDP ratio stood at 76%. In 2001, the ratio was just 32%. Banking system today looks far more mature and robust compared with the crisis period. Unfortunately, the profits that banks demonstrate are not priced in their shares. Due to current uncertainties of the global economy and debt crisis in Europe, banks are traded below their balance sheet value. The financial institutions are extremely undervalued. The inadequate share price prevents banks from attracting new capital through IPOs, or initial public offering, or SPOs. Many ask what happens if Western banks stop providing liquidity to us. I would say this time it's different. Non-resident liabilities have decreased from 11% in 2008 to only 5% today. However, despite the strong recovery from the crisis, the Russian banking sector still has its downsides. One is liquidity shortage. After an unprecedented increase, the deposit portfolio growth has hampered from 6.4% in the first half of 2011 to 3.3% in the first half of 2012. This happens along with a slowdown in the interbank lending market and an increase in retail lending. Next slide, please. Russia's banks are in shortage of long-term funding. Repo, even if extended to 6 months, 9 months, or even a year, is not totally justified. Banks are not interested to lock high collateral securities in the central bank for long period. According to some estimates, Russian banks have already pledged 60% of their liquid assets as collateral. Rating agencies warn that the increase of collateral pledged with the central bank and the limited availability of external funding can increase the risks of maturity transformation. So, effectively, what's happening? The Russian banks are taking the short-term maturity money, like 3, 6, 12 months, and give the loans for 3, 5 years. The gap in maturity is growing, which might, at a certain stage, lead to a very, very unfortunate situation when the bank will not be in a position to repay their debt. Russian financial system needs creation of long-term funding resources like pension funds, like endowments of universities, which, for example, in America represent a quite substantial part of investment money, and so on and so forth. Another risk factor for the system is a decrease in capital adequacy ratio to a record low of 13% in October this year. One of the ways to solve the problem is new sources of funding. For example, VTB found a way out of the dilemma. The bank was the first Russian bank to issue so-called perpetual or unlimited maturity subordinated loans Euro bonds, which 100% included in Tier 1 capital. Let me tell you a few words about Basel III implementation, given the Russian financial environment. In October next year, the central bank is expected to introduce additional adequacy ratios under the Basel III agreement. The situation is tricky, as Russia has not fully introduced Basel II yet. So we'll have to meet the more stringent standards of Basel III, jumping over Basel II. The central bank is set to take Basel III as an anti-cyclical mechanism, mitigating the risk of rapid growth in lending market in Russia. Retail lending is expected to grow by 40% this year, which makes the central bank nervous and worry about the increase in bad debt and another potential bubble. The regulator is thinking to curb lending by doubling reserve ratio from 1 to 2% applied to unsecured debt. What effect will the increased reserve ratio have on our business? Let's take our subsidiary VTB24, which is our retail network, as an example. The bank has 330 billion rubles of unsecured retail debt. We have calculated that if the ratio is increased, the tax base will be decreased by 4 trillion rubles, and the state will get 1 billion rubles less in taxes from VTB24 and 10 billion rubles from the banking sector as a whole. VTB24 will not be critically hurt. However, despite the concern of the regulator over increased lending, the credit quality has improved, as the NPLs, or non-performing loans, share in the banking system has decreased from 4.7% last year to less than 4% this year. The Russian banking community in general in favor of Basel III, but schedule for its introduction should be considered carefully. The key point is to secure competitiveness of our domestic financial system. The implementation can be safely extended by 1 more year, which is in line with the trends in the UK, in the US, and Europe. Basel III is commonly viewed as a more stringent regulatory mechanism. Clearly, regulation supervision must be enhanced. However, to make this enhancement more effective and beneficial for the Russian banking sector, Russia should not run ahead of others and not adopt the standards before Europe. There are other tasks that Russian banks have to solve before moving to Basel III. It is necessary to imply international financial reporting standards first. The application of IFRS will make the transition to Basel III smooth and even. Concluding the Russian part of the lecture, let me drop a few more points. Assessing the future of the sector, I would say that the banking consolidation in Russia will continue. 51 banks stopped operation in 2009, 52 banks in 2010, 33 banks last year. As of January 2012, there were 922 banks in Russia. The decrease mainly took place due to increase in core capital provided by stricter regulation norms. Russia's banking system is facing the problem of moral hazard. This relates to excessively risky policy of fraudulent management. To this end, the regulator should further increase regulatory or minimum capital to kick shell banks out of the system. The central bank should also be granted with the right to reasoned judgment and enhance its oversight over banks, not to make taxpayers and banks to pay for the frauds or others. The most of the examples here are Bank of Moscow and BTA Bank. Conclusions. What has changed? After we have covered the global regulatory landscape, After we have covered the global regulatory landscape and looked through certain jurisdictions, it is high time to ask, what impact did all these actions make on the financial markets globally? Let's take a look at the derivative first. The total amount of global derivatives outstanding in the OTC market in terms of face value has broadly been stable in 2009-2010. However, in the first half of 2011, OTC derivatives grew sharply to reach 708 trillion by June 2011. One of the reasons for this increase in the volume of derivatives relates to banks' efforts to get much needed liquidity. The value of OTC credit derivatives, credit default swaps, has decreased. The fact may be explained by a decrease in credit markets. Despite regulatory efforts to promote exchange-traded derivatives markets as opposed to the OTC sector, this segment still makes up only a small proportion of the total derivatives market. So the derivatives market has not decreased in value, and the issue of its global coherent regulation through standardized contracts and central clearing is still open. Another question, is the financial sector playing a less important role today? Has the economy become less dependent on the financial services? Let's take a look at the figures. In the US, the finance and insurance sector share in the national GDP exceeded the pre-crisis peak. Last year, the share stood at 8.3%. In 2011, in the UK, financial and insurance activities dipped to around 9% from its peak of 10.4% in 2009. Ignoring the contractions of the GDP, the sector still constitutes a major part of the country's economy. You may keep asking, then what has changed? And my answer is, though the figures are back on track, reality is different. What we have now is called new normality. Among its key features are exhausting monetary toolkit and increased volatility. Excessively low interest rates are often cited among the causes of the credit crisis. However, today the rates are even lower. The monetary policy can no longer be much relied upon. The average G10 real interest rate has fallen from about 3% in 2007 to practically zero today. Moreover, on the fifth year of the crisis, we see that ultra-low interest rate keeps zombie companies going and create another moral hazard. According to some estimates, over 50,000 companies are likely to go bust in the UK only if rates are increased. Moreover, full-scale implications of liquidity injections are not yet clear. Another risk for the economy is that the regulators do not seem to have an exit strategy. No one asked the question how banks would cope when interest rates get back to normal and QE ends. Uncertainty may be named as another feature of this normality. Today, investors and businesses are not sure whether positive GDP in one quarter will be followed by further growth in the next quarter. The miscorrelation between continuously decreased purchasing managers' indexes and some other positive signs of economic recovery illustrates the situation. The financial crisis has changed investors' idea of what is a safe asset. High-quality collateral is increasingly in high demand. Under Basel III reforms, banks are required to hoard more high-quality assets. There are growing fears that the collateral crunch could be the next thing to go wrong in capital markets. This crunch would hit economies by restricting banks' lending to consumers and businesses. Who could benefit from the situation? The answer is shadow banking. Those entities are out of the regulatory scope and don't have to meet high collateral requirement while lending. The ECB acknowledges that Basel III may provide further incentives for banks to shift part of their activities outside of the regulatory tumbling. IPOs are delayed. Instead, companies go to markets directly by raising bonds. Another key feature of the new normality is divesting, opposite to investment. According to some estimates, firms globally have divested more than $335 billion of assets since 2008. Analysts expect to see more active disposal of assets to refocus on core businesses and create strong platform for growth. In line with the global tendency, the VTB Supervisory Council, for example, has already announced the asset disposal program. The program is scheduled to be realized by the end of 2015. Despite the total revenue of the world banking sector had recovered to the pre-crisis level, its total costs have increased by 10% since 2007. As a result, the total profit of the banking sector has declined by 15% compared with the pre-crisis level. Due to worsening conditions in financial markets, banks are trying to keep their costs under control. One of the ways to do it is by reducing personnel and scaling down operations. One example would be enough. The number of jobs in the City of London is set to hit a 20-year low in 2012. Let me draw to a close. Here I would like to make a few points. Due to high capital requirements, tighter regulations, and increased competition from shadow banking entities, the banking sector is likely to consolidate further. As you can see, the chart says in the next 10 years, leading financial groups from emerging markets, rather than the advanced economies, are likely to appear as leading global financial institutions. Banks from China, India, and Russia, Brazil, I would add, are expected to account for most of this growth. The golden age of investment banking and its rapid growth that we have witnessed for the last 20 years are apparently over. It is unlikely to repeat in the midterm. An increasing amount of investment banks' revenue and earnings was generated by trading investments, including securitization and derivatives activity. Today, the tendency has reversed. Revenue across the top 10 investment banks was $141 billion in 2011, down 17% from 2010 and down 36% from 2009. And finally, is the crisis over? To make it simple, the credit crisis was the crisis of liquidity. However, the term credit comes from the Latin credere, to trust. In this sense, the banking industry is living through another credit crisis, the crisis of confidence, or the crisis of trust. LIBOR manipulation scandal, involvement of global banks in money laundering activities, and tax avoidance schemes, as we just recently witnessed, touched some great names in banking like HSBC or Barclays or JP Morgan, as well as reassessment of banking culture, which started in the professional community, highlight the issue. But I'm an optimist, and I'm sure the banking community worldwide is capable to overcome the current troubles, to restore confidence, and to focus on key objectives of its activities for hundreds of years, namely to support jobs and growth. In these connections, I agree with newly elected Lord Mayor of the City of London, Roger Gifford, who earlier this month said, "Real banking is a service, creating and supporting real jobs and real growth. It is a service for the good of business, to the economy, and to society." Thank you. I'm looking forward to your questions.
Andrei Leonidovich, thank you so much for a brilliant lecture. Now we have a time for questions. Let me ask colleagues to introduce yourself shortly before you formulate the question. So, who wants to be the first? Question, please.
Any brave people in this?
Yuri Fedotov, Head of Operations Management Department. My question is about the discussions of the possibility to change the deposit guarantee program in Russia while changing the limit of 700 rubles to 1 million. What will be the implication for the banks in this case?
Well, it will be different implications. I mean, as a representative of large banks, and here we are, we have the same opinion with Mr. Grev, for example. The two largest banks, like Sberbank and VTB, contribute the majority of this fund. On the other hand, we've seen over the last year or two, what we are thinking is unfair competition on part of the consumer banks, who is introducing a very high interest rate to collect more money from population. And the problem is that for people, if your money, if your deposit covered with insurance scheme, doesn't matter to what extent the bank they are investing, actually, or keeping their money, is reliable or not. Thus allows the less reliable banks, by paying more to collect more money and using them in a high risk operation. So our position is that after a certain limit, let's say after the 700,000, there should be some risk-sharing scheme. For example, if today the guarantee covers not only the 100% of the deposit, but plus interest, maybe the next stage is to increase it up to 1 million, but make the remaining 300,000 to be compensated maybe by 85% or 100% without interest or something like this, to make to lie some responsibility with the individuals themselves. But the issue is highly debatable. I think the scheme will be introduced. We had recently a meeting, some meeting with the Prime Minister, and the result was that to work a little bit more on this. But I think in one form or another, they'll be introduced. I don't think there'll be a very substantial negative effect. I think, on the other hand, I think such measures should be mainly introduced when it's necessary. During the crisis, for example, it was necessary because it provided more confidence, more trust in the banking sector. Today, I think the situation is stable, so to what extent this measure is needed. But it's political issue. I think it will be introduced. I think it will have not big negative or positive effect on banking sector. But I think the banks like Sberbank and ourselves will be arguing that there will be some kind of the risk-sharing scheme between the banks and the customers.
Thank you. Next, please.
Dmitry Volkov, Professor of Finance. My question is about current situation in European Union with some signs of a new crisis. What will happen if euro will collapse? So this week we are waiting for some announcements about decisions about Greece. What will happen? How it can influence Russian banking system, if after Greece there will be Hungary, Spain, and some other southern European countries.
Yeah, I mean, among the two major problems which is now discussed, I would name two. The European sovereign debt crisis, number one, and the so-called fiscal cliff in the United States. I just come back from a trip in the United States. I met I met different people starting from the assistant to President Obama on the economy and the leading chairman of leading banks. And of course, this fiscal cliff, which means that if President Obama does not agree on the level of debt with the Congress, with the opposition, I would say, that might lead to a substantial problem for American government to spend money, and actually there should be substantial cuts in spending, which might have an extremely bad negative effect on the global economy. But somehow people think that Mr. Obama will find a solution, but nobody knows how. But coming back to Europe, I think Europe is an extremely difficult case, of course, and I mentioned, I think, before that probably what we saw in Europe, that the corporate debt moved to a sovereign debt, though, of course, the governments are responsible themselves. I mean, it seems to me that the European crisis will not lead to collapse of the EU, for example. But I think the solution will be a long-term and will be protracted and difficult one. And so from this point of view, Europe will continue to have an extremely negative effect on the global economy. I think more and more the German government will take over the situation, though on another side they will have elections in 12 months' time approximately, which make probably more difficult for Madam Merkel to introduce new measures to announce new spending on this situation. But of course what we see in Greece now is protracted and long-term negotiations. I think they will find some kind of a solution. Unfortunately, Greece is not the single case. We have at least half a dozen of countries in Central and Western Europe or South Europe which might follow the suit. If we talk about the Russian financial sector, it's not directly exposed to European financial sector. We don't, Russian banks not keeping any sovereign debt papers or this kind of thing. Russian banking sector might be, as it was in 2008, 2009, affected through the general recession. I mean, and because Russian economy is still very much rely on the export of commodities. And if Western Europe, for example, start to buy less, we also have China, which has started to produce more itself, like coal and steel. Together, it might lead to a substantial drop in Russian export. That will be, like in 2008, 2009, quite a severe blow to Russian economy. In 2008, 2009, without being directly exposed to world financial crisis, we lost 9% of GDP just because of this, through our dependency on a natural resources-oriented economy, which is the key problem for Russian economy. Unless we change it, we always will be vulnerable to whatever changes, to whatever negative developments we see all around the world.
Any questions? More? Please.
Alexander Bukhvalov, the head of finance department. So what do you think about the perspectives of the development of the private equity market in Russia? Private equity.
Well, we are working with a number of leading private equity funds, global funds. For example, one of the members of our board is Mr. David Bonderman. Mr. Bonderman is who is now 70, I mean, is some kind of the legend in America, maybe less known worldwide, but he's the kind of people known in America like Mr. Soros or Mr. Buffett. He's created his own private equity fund, and we're working on a number of deals. One of the most famous, getting some maybe negative press also, was Lenta, which his TPG fund together with VTB bought. We had some conflicts with other shareholders. I mean, the problem with private equity funds is the same as for what we call the global or Russian investment climate in Russia. When Mr. Putin mentioned that Russia is now ranking 120th on the World Bank ranking doing business, that means that is not very attractive for private equity funds, because of course private investment, direct investment, they are actually vital, they are key. They are much more important, I think, than just portfolio investment in stocks of Sberbank or VTB. When actually investors are making direct investment, buying a stake in different factories or chain of shops or this kind of thing. But I think the future will very much depend on whether we manage, like Mr. Putin mentioned, to move from a 120th place to 20th in a few years' time. I think the global environment and the things like a proper legislation and proper rule of law or other things which make for investors the country to be convenient to work in, I think that's vital. It's a definitely growing interest to this from the West, from the East also. The Chinese are very much interested, the Gulf people. But I think if we want really to expand in this area, we really have to create a much better conditions to make investors be more confident in the future of Russia, in its changing economy, in providing long-term stability. I mean, that's all the general things. But it's a very interesting area. And, VTB also with private investors. Another example is Pulkovo Airport. We're building with Frankfurt Airport. That's a private PPP project, but we invested, each of us invested about 200 million euro in equity, Frankfurt Airport and VTB, and we'll be selling it only when we complete the construction next year. We're now on the same principle building some other infrastructure projects. So I think that the future is there, but we really need to change quicker the environment to make it more friendly to investors.
More questions? Yeah, lady.
If you will forgive a question from a non-financial expert, my name is Robin Jensen. I'm Director of International Programs. And looking at the picture you draw, I still feel that we are all around the world very, very vulnerable. And I'm curious about why there isn't more support for a financial transactions tax. I understand the danger of investment going to countries which haven't instituted this, but why can't some kind of agreement be made so that the sector bears more of the risk?
Well, you see, yes, I agree with you. You know, when the crisis happened first in 2007, I was in Washington on a short trip, and I called my friend from the Central Bank of Russia, Mr. Lukayev, who was the first deputy governor, and I asked him, look, Alexei, what we're planning to do? I mean, there's a crisis. He said, what to do? Look, I mean, from what we understand, the previous crisis of such scale happened in 1928 or 1929 during the Great Depression. So it was 90 years ago. So this crisis we already overlooked. But we will not be alive when the next happens. So effectively we can do nothing. I mean, that was not, as history showed, was quite accurate, because I agree with you that we are living through a very uncertain period of time, or now it's more famous word is volatile. But it's a lot of risks and uncertainties in the future, which makes it difficult to have a long-term strategy or to expect growth or strong growth even in the midterm period of time. But you see, there should be a proper balance between the strictness of regulation and burden of the banks and the ability of the banks to provide, as we're talking about the banks, we're saying this is the blood vessels of any economy. What's happening now? The number one issue for the banks is a capital base. With the new introduction of new rules, banks have no enough capital. What they're doing now, if they are not in position to raise new capital, they are selling assets. They are not lending money. So what we see now in Europe, for example, they just stopped to lend money to the economy, in spite of the fact that they receive from the European Central Bank money at zero cost. They just don't lend money because they don't have capital. So what we are arguing, the bankers, the introduction of any further burden makes it more difficult to conduct an efficient business. And if we don't have efficient business, the price of our shares fell substantially. We are not able to raise capital. If we're not able to raise capital, we're not able to lend money. So it's a vicious circle, and to somehow to break it, we need to provide for a certain period of time a stable, good financial results. At the moment, the banks, as I mentioned, traded below capital. What does it mean? It means that VTB, for example, share prices fell more than 70% as a result of the crisis. It means that the banks in Europe today cost maybe 1/3, or American as well, of the capital. It's nonsense, because you've got the capital of, let's say, $1 billion, which if you close the bank, you can withdraw this billion. But the price of it is only 300 million, because investors do not trust the bank that they will be able to provide a good yield, that they don't have a problem. So, I mean, the argument is only one. The more burden we have on banking sector, the more difficult for banks will be to their activity, and there will be less money coming to the economy, less loans, less credits. So that's it. I mean, there's no other things. I mean, there should be some balance, because it's partly a joke, but I spoke to to our governor of the central bank, Mr. Ignatiev. I say, what's for you is the most favorable capital adequacy? He said 100%. With 100%, you can't work. it's useless. You know, you don't earn money. If you don't earn money, nobody investing in you. So I mean, basically, that's the only reason. I mean, if you have a tax on your transactions, the more business you are doing, the more you are paying. The more you are paying, the less motivation for you to expand your business.
So I remember that the question was just here.
Okay, thank you. My name is Irina Lekomtsova. I'm a GSOM student and also a head of organizational committee of a conference Future Management, which is GSOM based, and taken a step of financial road today, and continue the collaboration of VTB and Graduate School of Management, and the participation of VTB in a previous conference Future Management. I would like to invite you as an honorable speaker for next conference, Future Management,
when will be?
April 2013. And if you are interested, I would like to handle you a list of documents. So,
thank you.
Thank you.
I'll try my best. Yeah. Thank you.
It was not a question.
But that was answer.
Yes, sure. Okay. Let us, somebody ask the last question because we have no time for. Yes, please.
Anton Remnev, master student. Could you please specify what are the main challenges of joining WTO from the banking sector perspective, if there are any? Thank you.
I don't see much for the banking sector. I mean, there was some concern that joining WTO in due course, in due time, would allow the foreign banks to open branches rather than subsidiaries in Russia, and that would give them a special, I would say, competitiveness or privileges in competitiveness, which I don't think the case today. I mean, what we see now in Russia, that foreign banks withdrawal from Russia for a number of reasons. Main reason, I don't think any politics or business. It's mainly that as a result of the crisis, the banks started to be more oriented on the major markets, and they are cutting their operations. They're still very much international. I mean, Citigroup is still conducting business in 160, in 160 countries, including Russia. But over the last few months, you saw that a number of banks left Russia, and so we don't see too much problem directly. But as you know, I mean, yesterday only, I think Mr. Putin had a special meeting on WTO. I think joining WTO might have a substantial effect on other industries, on our clients. We don't have so much clients in agriculture, for example, but we do have in some other industries which might be badly affected by WTO. Unfortunately, the Russian economy is not very competitive. So by opening the frontiers, opening border lines for Russian products, not necessarily lead to advantages for our industry. But on the other hand, today, you can't not to be global. You can't be part of this. If you want to create a competitive industry, there should be global industry. You can't produce aircraft today only for local market. There should be a global market, and so on and so forth. So I think in general, it's a right move. It's a right step toward the global cooperation. But for banking sector, no. I think we should grow. We should grow globally. That's important for us. I think that's why we spend, I mean, VTB is present in 20 countries, which only generate us only 15% of our income. But if you want to be global, you should spend time. And that's why we are working from Africa to Asia and to Western Europe and America. Because though what I was saying before meant that there is quite a big challenge for large international banks from different points of view after the crisis, I still believe that the future is in the hands of the global large financial institutions which will be in the position to provide a global finance. So I don't see much problem. I think we should be just very careful in our strategy, Russian banks. We should really take into account all these volatilities of the markets. And otherwise, I think that's not the area of particular concern when we're talking about Russia joining WTO. Right, thank you very much. I would like to wish you every success. You, I think, selected a very good profession, which is very much in demand in Russia and globally. So I wish you every success, and when you are graduated, we'll be happy to send applications for jobs. I mean, we will work with your directors. And okay, every success. Don't forget about the private life, which is important for students. I mean, that is not only that's not everything in our world. Thank you very much.
So thank you very much. So it was a lecture, I believe, a future dean of high school management. Thank you so much. Thank you for your questions. Good luck.